Silver is no longer making headlines for explosive gains or dramatic collapses, and that silence is precisely why the market deserves close attention right now. After one of the most volatile periods in decades, silver has settled into a relatively narrow trading band between $70 and $80. On the surface, that may look like calm returning to the market. Beneath it, however, this range represents a critical phase where positioning, macro forces, and institutional behavior are quietly determining what comes next. Periods like this often matter more than the moments of chaos that precede them. Before going further, it's worth saying this clearly. If you value disciplined, data-driven market analysis that prioritizes structure, macro context, and risk awareness over noise, this is exactly the type of discussion worth staying with. What follows is not about short-term excitement. It's about understanding how markets actually transition from extremes into their next phase. Only weeks ago, silver was trading at historic highs after an extraordinary rally. Prices moved faster than fundamentals could reasonably justify, volatility exploded, and participation surged across futures, ETFs, and retail platforms. When the reversal came, it was sharp and unforgiving. A significant portion of those gains was erased in a matter of days, as leveraged positions were unwound, margins were raised, and risk appetite shifted. Since then, silver has stopped falling aggressively, but it has also failed to reclaim its prior momentum. Instead, it has entered a holding pattern between $70 and $80. This range matters because it is not random. It reflects where the market is attempting to rebalance after an extreme dislocation. On the upside, the upper 70s to low 80s area has repeatedly attracted selling pressure. On the downside, dips toward the low 70s have drawn enough demand to prevent a full breakdown, at least for now. This tells us that neither side currently has full control. Buyers are cautious, sellers are patient. That balance is what stabilization looks like in real time. From a market structure perspective, this is a classic post-shock consolidation. After violent moves, markets often compress as participants reassess assumptions. Volatility contracts, volume becomes more selective, and price action appears indecisive. This is not a sign of weakness or strength by itself. It is a sign of digestion. The key question is whether this digestion resolves into continuation or further correction. Macro conditions remain central to that outcome. The US dollar has been relatively firm, limiting upside pressure for dollar-denominated commodities. Bond yields, while no longer surging aggressively, remain elevated enough to compete with non-yielding assets like silver. Expectations around central bank policy have become more cautious and less speculative. Markets are no longer pricing rapid or aggressive shifts in monetary conditions, and that has reduced one of the major tailwinds that previously supported precious metals. At the same time, silver's industrial narrative remains intact but muted. Long-term demand tied to electronics, energy transition technologies, and infrastructure has not disappeared. However, industrial demand does not typically drive short-term price behavior in futures markets. In the near term, silver is still being driven primarily by positioning, liquidity, and macro sentiment, rather than by physical supply-demand balances. ETF flows offer a useful window into this behavior. During the sell-off from the highs, silver ETFs experienced sharp outflows, reflecting both profit-taking and risk reduction. More recently, flows have stabilized with intermittent inflows and outflows rather than one-directional movement. That suggests panic has largely subsided, but conviction has not returned. This is consistent with a market that is waiting for confirmation before committing to a new direction. Institutional participants tend to thrive in these environments. Unlike momentum-driven traders, large funds and asset managers are comfortable waiting. They observe how price behaves around key zones, how volatility evolves, and how macro data alters expectations. The $70 to $80 range provides a natural laboratory for this observation. If price begins to compress further and volatility continues to decline, it often signals preparation for a larger move. The direction of that move, however, is not determined by the range itself, but by what changes outside it. Repeated tests of support and resistance are especially informative here. Each time silver approaches the lower 70s and holds, It reinforces the idea that demand exists at those levels. Each time it approaches the upper 70s and fails, it reinforces the idea that supply remains active. Over time, one of those forces typically weakens. Either buyers become exhausted and support gives way, or sellers step aside and resistance breaks. Markets rarely remain balanced indefinitely. It is also important to understand silver's behavior relative to gold. Gold has been comparatively more stable, reflecting its role as a reserve asset and institutional hedge. Silver's higher volatility reflects its dual identity as both a precious metal and an industrial commodity. When uncertainty rises but growth expectations soften, silver often underperforms gold. The current range-bound behavior suggests that uncertainty remains, but panic has eased. Looking ahead, there are several plausible paths the market could take. One scenario is continued stabilization. In this case, silver remains trapped between $70 and $80 for an extended period. Volatility gradually declines, speculative interest fades, and the market rebuilds a base. This outcome tends to frustrate short-term participants, but can lay the groundwork for a more sustainable move later. Another scenario is a downside resolution. If macro conditions tighten further, if the dollar strengthens materially, or if risk appetite deteriorates across broader markets, silver could lose support in the low 70s. A break below that zone would likely trigger another wave of position adjustment, not necessarily because fundamentals have deteriorated, but because market structure would shift again. Such moves are often swift, but not always long-lasting. A third scenario involves a volatility-driven rebound. If macro data weakens in a way that shifts expectations around monetary policy, or if financial stress reemerges elsewhere, silver could attract renewed interest as a hybrid hedge. In that case, a decisive move above the upper end of the current range would signal that sellers have stepped aside and that the market is repricing risk once again. Sustaining such a move, however, would require confirmation from currencies, rates, and broader sentiment. What matters most in the coming weeks is not prediction but observation. Watch how silver reacts to economic data rather than the data itself. Watch whether volatility expands or contracts. Watch how quickly price responds when it reaches the edges of the range. These behaviors reveal more about market intent than headlines ever will. Silver's current behavior between $70 and $80 is not a sign that the story is over. It is a sign that the market is thinking. Periods of reflection in markets are often underestimated because they lack drama. Yet historically, they are where longer-term direction is decided. Whether this range proves to be a floor, a pause, or a prelude to further adjustment will depend on forces that extend beyond silver itself. For those who approach markets with a professional mindset, this is the phase that deserves the most attention, not because it is exciting, but because it is informative. Silver has moved from excess to evaluation. The next move, when it comes, will likely be defined by how convincingly the market resolves this balance. If you find value in analysis that prioritizes structure, macro context, and disciplined reasoning over speculation, consider staying connected for future discussions like this. These transitional periods are where clarity slowly emerges, and understanding them is essential for anyone studying how markets truly function.